There's a big trend in investing. You can see it on this chart of inflows to ESG funds. They peaked in 2020. ESG funds say they judge companies on environmental, social, or corporate governance factors, and they aim to attract investors looking for a more ethical approach.
ESG funds have been around for quite some time, especially in Europe, where the trend has really been sort of ahead of where we are in the US. But it wasn't until last year that we really saw an explosion of interest.
Many of these funds have recently outperformed the markets, but regulators say they may not be all they claim to be. We'll explain why. The tension around ESG funds has to do with the way that they're built. There are a few strategies, including exclusionary, single theme, and best in class. Let's start with the exclusionary approach.
So when a portfolio manager takes an exclusionary approach to making an ESG fund, they'll basically decide what category of companies they don't want to have in their portfolio, no matter what. A really common category for this is weapons manufacturers, for instance, or tobacco companies or casino operators. Those types of companies are commonly totally excluded from ESG funds.
Other ESG funds tie themselves to a single theme. The index ticker SHE tracks gender diversity by including large companies with at least one woman in a key leadership role. That includes companies you might recognize like PayPal, Home Depot, and Netflix. There are also ESG funds tied to solar energy and water, which promote sustainable use of natural resources. Funds like this can help an investor put money into companies that might improve society. ESG funds can help an investor reach their moral goals, but the funds have also earned solid financial returns in recent years. A Wall Street Journal analysis of ESG equity funds found that nearly 150 of about 200 funds outperformed their benchmarks. That's driven by tech stocks, which are commonly held by ESG funds. More than half of these funds hold Microsoft. Nearly half hold Alphabet. In other words, ESG funds are betting big on tech. But critics have questions about tech companies' inclusion.
Tech stocks are a sort of interesting problem when it comes to ESG because a lot of these companies do have relatively strong environmental practices.
By 2030, Microsoft will be carbon negative, not just across our direct emissions, but across our supply chain too.
But then on the other hand, they may have some serious problems when it comes to the S component of ESG. For instance, we have companies that have come under fire for their data privacy issues. We have companies that have been criticized for the way they treat contractors and third-party workers.
But here's the catch. A fund manager can just use looser criteria for which companies it includes in the ESG. This makes it easier for more companies to qualify, even ones that seem counterintuitive to the overall mission. One such approach is called best in class.
When we asked BlackRock last year how they were putting together ESG funds and still including major oil and gas producers, they said that they tend to take a best-in-class approach. An oil company could still belong in an ESG fund if it's shown to have done better on ESG principles than its competitors within the same industry.
Using a best-in-class approach means that a company only needs to be better on ESG principles than their competitors. But an investor doesn't always know how that fund is built.
The problem is a lot of investors don't tend to read the fine print that comes with all of their funds when they're deciding what to put their money into. They may just be attracted to a fund because they see the name of the ticker or the name of the fund itself and think, that seems to align with my investing goals. But when you look under the surface, you'll often see there are companies in these funds that don't seem to align with the stated goal of the fund. And that really comes down to the fact that there's still no standard definition of ESG or what constitutes an ESG fund.
These details matter because they can change how the fund performs, but critics say that they can also compromise the fund's stated mission for high ethical standards. Recently, critics in the federal government have sounded the alarm on sustainable investments. Here's SEC Commissioner Hester Pierce talking about how companies are assessed for ESG funds.
We see labeling based on incomplete information, public shaming and shunning wrapped in moral rhetoric, preached with cold-hearted, self-righteous oblivion to the consequences which ultimately fall on real people.
And it's not just the SEC. The Labor Department proposed a rule this summer that would make it more difficult for 401k holders to put their money in ESGs. The department says the rule is needed to protect workers from investments that aren't in their best financial interest. But pension fund managers and Democratic lawmakers say the Labor Department's proposal would undermine a tool of positive social change. Regulators are still considering whether or not to change any rules. Some lawyers and regulators think that there should be more standardization across ESGs to prevent investors from being misled. And others say it's a step in the right direction to have Wall Street thinking about sustainability at all.